You've heard of IBM, of course, but I'm willing to bet you don't know the real story of its survival. Not the story of its products, but the story of its money. Today, we're going to look at how this tech giant reinvented itself as an AI powerhouse, told completely through the numbers on its profit and loss statement.
I mean, think about this for a second. It's one thing for a little startup to pivot, right? That happens all the time. But what does it take for a company that's over a century old to navigate through massive, world-changing tech revolutions and come out the other side? That's the incredible, almost unbelievable story of IBM's financial survival.
To really understand the comeback, you have to feel the collapse, and I mean feel it. In 1993, IBM lost $8 billion. Now, at the time, that was one of the largest corporate losses in U.S. history, period. The undisputed king of computing was right on the brink of going under.
So, how on earth did they pull out of a nosedive that steep? Well, we're going to put on our CFO hats for this one. We're going to look right past the slick marketing and the big product announcements. We're going straight to the source code of the business. It's P&L.
Okay, here's our roadmap. We're going to tackle this in 4 acts. First, the hardware empire and how it all came crashing down. Then, the massive company-saving pivot into services. Third, the shift to software and the whole new challenge of the cloud. And we'll wrap up with the modern financial playbook that IBM is running today.
All right, let's kick things off with Act 1. This is IBM, the undisputed king of computing.
You know, for decades, IBM was computing. From its early days in 1911 all the way through the 70s and 80s, if you were a serious business, you ran on Big Blue. No question. But look at this timeline. After hitting a peak of around $69 billion in revenue in 1990, the company just fell off a cliff. And that's what led to that catastrophic loss just 3 years later.
Now, this chart right here, this tells you exactly why they were so vulnerable. Just look at that revenue mix. A staggering 60% of their business came from one thing: selling hardware. Mainframes, servers, storage, the big iron. They controlled the whole ecosystem, which meant incredible profit margins, until it didn't.
So what went wrong? Well, in a word, the world changed. The PC revolution, led by Microsoft and Intel, came along and turned that expensive hardware into a low-margin commodity. All of a sudden, IBM's core business, the thing that made them all their money, just saw its profitability collapse. It's a classic case of a giant getting completely disrupted.
And this crisis brings us to Act 2, the Great Services Pivot. This was led by a new CEO, Lou Gerstner, who, fun fact, was brought in from completely outside the tech industry.
Gerstner made this brilliant, almost counterintuitive bet. He realized customers didn't just need to buy more boxes, they needed help making all this new technology actually work together. So he bet the entire company's future not on hardware, but on high-value consulting and IT services.
And wow, look at the result of that bet. By 2002, the P&L is almost unrecognizable. Hardware, which used to be 60% of the business, is down to 35%, and services, it surged to become half of all revenue. This was IBM's first great reinvention, right here.
The financial impact of this was just profound. A services business gives you predictable, recurring revenue. That means you have money coming in consistently from long-term contracts, not just big, lumpy sales you have to hope for. This stabilized their earnings, it improved their margins, and maybe most importantly, it restored the trust of their investors.
But hey, this is the tech world, right? It never stands still. And that brings us to IBM's second massive reinvention, the strategic shift into high-margin software and the dawn of the cloud.
Riding that services and software wave, IBM hit an absolute golden era. By 2011, their revenue peaked at over $100 billion. They had operating margins consistently over 20% and were pulling in massive profits. The turnaround was a spectacular success.
But then, disruption came knocking on the door again. A whole new model emerged, the public cloud. And it was dominated by companies like Amazon Web Services and a re-energized Microsoft with Azure. IBM? Well, they were late to the party, and their revenue began a long, painful slide that lasted for years.
So facing another existential crisis, IBM had to make another massive bet. This time, it was a $34 billion bet on a company called Red Hat. This wasn't just any software company. Red Hat was a leader in open-source technology, and that deal gave IBM a credible, powerful entry into the modern hybrid cloud world.
Along with buying big, they also made a strategic cut. They spun off their lower-margin infrastructure business into a new company called Kyndryl.
Now, this is such a classic CFO move. They willingly gave up billions in revenue to create a healthier, more profitable company. It was a signal to investors that they were focused on the quality of their earnings, not just the size.
And all of that brings us to the modern IBM and the key financial lessons we can pull from this incredible, decades-long journey.
Take a look at what the P&L looks like today. It's this beautifully balanced strategic mix. You've got high-margin software, powered by Red Hat, making up 40% of the business. Consulting is still a huge piece at 35%. And the rest is rounded out by their more stable, traditional infrastructure business.
So what's the first big lesson here? It's that revenue quality is so much more important than revenue size. Yeah, IBM's total revenue is lower than its $106 billion peak, but the quality of that revenue, how profitable and predictable it is way, way higher. The second lesson is all about how your mix of businesses drives your profit margins. When a huge chunk of your company is software with like 80% gross margins, it just lifts the profitability of the entire enterprise. It creates this powerful operating leverage, which means that for every additional dollar of software you sell, most of it falls straight to the bottom line as pure profit.
And this all leads to the one number that really matters for the modern IBM: free cash flow. This is the actual cash the business generates. It's what you can use to pay dividends, buy back stock, or reinvest. And because they're so focused on those recurring contracts, they generate a ton of it very predictably. It's the ultimate measure of financial health.
This quote really just sums it all up perfectly. It calls IBM's journey a textbook case of strategic revenue reallocation to protect ROIC. And ROIC, or return on invested capital, is just a fancy way of measuring how efficiently you turn your money into more money. Every single move we've talked about was designed to make that number better.
So we end right where we started, from hardware to services, then to software, and now to hybrid cloud and AI. Just think about it for a second. How many companies can you name that have managed to fundamentally reinvent their financial engine not just once, but 4 separate times to survive and thrive? It's an absolutely incredible story of resilience, told right through the lines of a P&L.